Welcome to the Deep Dive. You've given us some really interesting material this time. It's the Q&A session that followed Shape Robotics' recent first quarter results.
That's right, yeah. After what looked like a pretty strong start to the year, management sat down for questions. And it seems like the focus was really on, their financing, how they handle their particular market, and what they see coming up.
So our mission for this deep dive is to, cut through all that discussion and pull out the really crucial bits. What does this Q&A actually tell us about how they're funding growth, dealing with those famously long payment cycles, and their plans for expansion? Let's just jump straight in.
Okay, so probably one of the biggest things they talked about was a new financing agreement. It was announced just before this Q&A, actually.
Right, the Unicredit one, a 7.5 million euro revolving credit facility. That feels like maybe more than just routine financial stuff, doesn't it?
Absolutely. Management didn't just announce it. They really framed it as like a confirmation of Unicredit's ongoing support, a validation almost of their growing contract base. And they were pretty careful to point out this isn't just refinancing old debt. It's specifically an extension of support.
An extension. Okay, so Unicredit is leaning in more. What's special about this particular facility then?
Well, the structure is pretty key. It's secured through a strategic partnership with the European Investment Fund, the EIF. They're acting as a co-guarantor.
Ah, the EIF.
Yeah.
So that extra layer of support, that probably helps make the terms better, right? And sort of signals confidence in the business.
Exactly. It likely means very favorable terms and really underlines the quality or the perceived quality of what they're doing.
And practically speaking, what does this let them actually do?
Well, it gives them that crucial flexibility for financing growth. Management seems to feel it provides a strong foundation for the next 2, maybe 3 years, specifically helping them manage revenue and, critically, those tricky payment terms that just come with the territory for them.
Which, is a perfect segue into that other major theme from the Q&A, how they actually cope with customer financing and those really long payment cycles.
Yeah, this is really core to their whole operation, both the challenge and the success, I suppose. Their main customers are in the public sector, mostly on these big projects.
And these projects, they're often tied into big EU funding pools, like from the European Commission or programs like the Recovery and Resilience Plan. Is that right?
Precisely. And management was very clear on this point for the areas they work in: Romania, Slovakia, Poland, really any EU country with these big centralized tenders. These long payment cycles aren't weird. They basically describe them as just normal for this type of EU-funded business.
Okay, normal for them. There was a question, though, about whether the company is kind of acting like a bank, by essentially funding these deliveries for so long.
Yeah, it's a fair point. And management basically confirmed that, yes, in a way, financing customers and deliveries is just part of their day-to-day. They see it as like a necessary function for any company that's operating, and importantly, growing fast in this specific sector.
Because growing fast means bigger projects, right? Which needs more working capital up front before they actually see the cash.
Exactly. The faster they grow, the bigger the need to finance those receivables that the growth generates. It's just a direct consequence of moving quickly.
And that ties straight into cash flow management and trade receivables, basically, the money customers owe them.
Right. And trade receivables, they can really balloon when you have long payment cycles. So, it's definitely something investors watch closely. Management did note, though, that their handling of these receivables has apparently been improving day to day over the last year. So, suggesting they're getting a better handle on it.
And they really stress that having access to financing, like this new Unicredit facility, but also things like factoring, is absolutely critical, not just for growth, but for managing cash flow and fundamentally de-risking the company.
Yeah, that de-risking point is really important. It highlights that these financing tools aren't just about having cash to spend. They're a core part of their financial stability plan. Bridging that gap between doing the work and getting paid, sometimes months later.
So let's dig into factoring a bit. They mentioned mortgaging invoices. How sustainable do they think that is for the long haul?
Well, management's take is that factoring is very sustainable, but, and this is a crucial but, it all depends on the quality of the debtor.
And in their case, the debtors are these public bodies backed by EU funds.
Exactly. They described those EU funding sources as very strong, having a high rating. Think of it like lending money that's backed by a really solid source.
Okay.
So, because of that high rating, banks are comfortable financing these specific receivables, and they can do it through factoring at what they called a very low cost.
So it's the reliability, the high credit quality of these EU-backed projects that makes factoring such an efficient and cheap tool for them to manage cash flow in this specific business.
That's the argument, yes. They even sounded keen on doing more factoring, exploring other options. They specifically mentioned looking into the Polish market for this.
Interesting. Okay, moving away from their core EU business, what about geographic expansion? Conditions must be different elsewhere.
Yeah, they touched on that. They mentioned the context in places like Romania, which now has a pro-EU presidency, and the situation in Poland. They were careful not to get political, but basically said any news supporting EU integration and funding is, obviously good news for their business.
And they pointed to something significant that's public knowledge.
Yeah.
The extension of the Recovery and Resilience Plan period by another 18 months.
Right. That extra time, that's seen as really favorable. It gives them a longer runway for potential future projects in their main EU market, which leans so heavily on these funding cycles.
But okay, when they look at expanding into, say, Southeast Asia or the Middle East, the whole payment situation must look pretty different from the EU model.
Oh, definitely. While that EU funding makes reliable, low-cost factoring possible because the debtors are high quality, they fully acknowledge that expanding into SEA or the Middle East, that's likely going to need different ways to manage risk.
Like asking for money up front, maybe. Or using insurance.
Yeah.
Different tools.
Right. They said initial deals might involve prepayments, and the exact financing would depend on the deal size, the customer, all that. But it's clear they see these regions as important for expansion. Their products fit, they think, even if the financial plumbing needs to be different.
And what about the U.S. market? They have partners there, but no big direct push announced.
Yeah, management basically pointed to the tariff situation as the main reason they're being cautious about a major U.S. presence right now.
So their products can get into the U.S. through partners like TDC and Lenovo, but a big manufacturing or production plan for the U.S., that's on hold until they see how these trade tariffs shake out.
Yeah, they're essentially just waiting, watching that trade dynamic before making a bigger move stateside.
Okay, and finally, that classic question investors always ask. Outlook and guidance. Q1 was strong, so why no guidance raise?
Management's answer was pretty measured, almost understated, really. They just said the strong Q1 only emphasizes that the guidance was well selected to begin with.
Huh. So they see the good start as just proving their original forecast was right, not necessarily needing an immediate bump up.
That seems to be their position, yeah. They explicitly said they'd rather not comment on raising guidance and just let the results speak for themselves down the line. Sounds like they're sticking to their guns on the forecast for now.
Got it. As a small aside, they did mention the Q&I happened on a Danish public holiday. Framed it as making sure everyone got the info at the same time, which was, a thoughtful point.
And while they definitely avoided talking about the share price itself, they did kind of subtly acknowledge the positive market reaction, noting a quite interesting rally up since the last Q&A.
Okay, so let's bring all these pieces together. We've got the new financing, the focus on managing these long EU payment cycles with tools like factoring, and then these different strategies needed for expansion. What's the big picture takeaway from this Q&A session?
Well, I think the core message is really about how they're structurally set up to handle the very specific financial challenges of their business model, that Unicredit facility, and how they use factoring, which works so well because of the high quality of those EU-backed debtors. Those are the critical mechanisms, right? They bridge that working capital gap created by those long public sector payment cycles.
Yeah, and understanding that financial scaffolding, as you put it, seems really key for you, the listener, to see how they actually fund their growth and manage risk, especially given how much they rely on these big government and EU projects. And the extension of things like the RRP just adds more context for potential future business in that core kind of favorable market.
But, and it's a big but, as they look outside the EU to places like Southeast Asia or the Middle East, they know that financing playbook totally changes. They'll need different tools, maybe prepayments, insurance, who knows, because they won't have that same pool of low-cost, high-quality, EU-backed receivables to factor.
Right. It's a good reminder that expanding geographically isn't just about finding new customers. It's often about completely rethinking how you manage financial risk in those new markets.
It's a fascinating challenge, definitely.
Okay, well, that brings us to our segment. This is not financial advice. Based just on the mechanics we've talked about from this Q&A, here's a provocative idea for you to consider.
Okay, let's hear it. If their knack for using low-cost factoring against those high-rated EU debtors is like a core advantage that lets them handle working capital really well while growing fast in that market.
Then maybe you could think about a pair trade. Imagine going long on Shape Robotics, basically betting on that efficient, EU-focused financial model continuing to work well and manage cash flow.
And pairing that with a short position on, let's say, a hypothetical competitor, someone also in the public sector, maybe, but with a lot more exposure outside that EU funding system. Perhaps in places with less reliable payments or without access to that kind of cheap factoring.
Right. The idea is you're specifically betting on the structural cash flow advantage that comes from their EU funding source and their factoring setup compared to peers who might look similar but just don't have that same financial plumbing efficiency. It's really a bet on the balance sheet mechanics.
Yeah, it's a very high-level concept, of course. It would need a much, much deeper dive into the actual company financials. And remember, everyone, this is purely for discussion based on the Q&A themes. Absolutely not investment advice.
Definitely not. Always do your own thorough research. So, to leave you with a final thought from this deep dive, given how absolutely critical those EU funding cycles and, let's face it, political stability are to their current financial strategy in their main market, and they've clearly said they want to expand into places needing totally different risk approaches, how might success or even struggles in those new markets eventually change the company's overall financial risk profile compared to the more, let's say, predictable EU model they rely on now?
That's a key question for them, looking down the road.
Well, thank you for bringing us this material for the deep dive. We really appreciate you sharing it. Keep digging into these topics and the connections we talked about.
Yeah, stay curious and keep asking those important questions.
And if you happen to have other source materials you think we should explore, definitely share them with us. Until next deep dive.